Good afternoon. I'm Julie Godshall-Brown with Godshall Professional Recruiting and Staffing. 2 weeks ago, the Greenville Chamber, in partnership with Ogletree Deacons, hosted a webinar on the impact of the new Department of Labor overtime rules under the Fair Labor Standards Act. We would like to thank the participants in that earlier discussion. Tom Bright, shareholder with Ogletree Deacons, Chuck Blankenship, Senior Vice President of Human Resources with Bank of Travelers Rest, Rachel Putman, Vice President of Human Resources, Goodwill Industries of the Upstate, Leslie Hayes, President and Organizational Coach of the Hayes Approach, Charlotte Lyda, Human Resources Director with the Cascades at Verde, Pam Nally, Regional Human Resources and Operations Manager for Belks, Tom Dumit, Vice President, Human Resources of Cafe Enterprises, better known as FATS Cafe. For those who were not able to participate live or would like to review key points, today's session will provide a high-level overview of the overtime rule changes provided by Tom Bright, shareholder with Ogletree Deacons, as well as highlights of that original panel discussion and some additional observations by our group. To help us do that, Leslie Hayes has also rejoined our team today. Thank you both for participating today.
Well, thank you, Julie, and I'm glad everybody has, for anybody who's pushed on this link to join us as we kind of summarize what we discussed back on the 22nd. Just for a little bit of historical recap on how we got to where we are today. On March 13, 2014, President Obama called for, quote, modernizing and streamlining the overtime regulations to address the changing nature of the workplace. What he wanted to do was to try and simplify the rules. On June 6, 2015, the proposed rules were published in the Federal Register, and a comment period was opened for people to make comments. Interesting that during that comment period, there were over 280,000 comments to these regulations that were presented by any number of different stakeholders. On September 4th, 2015, the comment period closed, and the Department of Labor went back to the drawing board to address the comments and finalize the regulations. Finally, on May 18th, 2016, the final rules were published, and they are set to be effective December 1st, 2016. So what is it that these changes to the regulations will do? The changes focus on the definition of who constitutes an exempt employee under the Fair Labor Standards Act. And what the regulations did is they focused on one aspect of the definition of exempt, which is the guaranteed salary. As you all know, the exemption has two prongs to the definition. Number one, there must be a guaranteed salary paid each week. That guaranteed salary is currently at $455 per week, which is $23,660 per year. The change that has been implemented is to raise that amount to $913 per week, which is about $47,476 per year. The second prong of the definition is that not only must you be paid a guaranteed salary, but you must satisfy one of the duties tests for one of the white-collar exemptions. That is the executive, the administrative, and professional exemption. While there was speculation that and much gnashing of teeth that the Department of Labor was going to change the primary duty test for the white-collar exemptions, the Department of Labor chose not to do so, and therefore did not make that change. So the only change we're really contemplating is a change in the guaranteed salary amount. It applies to the executive, administrative, the professional, which includes the learned and creative professionals, and the computer professional employee. Now, the second change in the regulations was to provide for a mechanism to upgrade this salary test every 3 years. And I won't get into the complicated nature of how that's going to be calculated, but the first change will occur January 1st, 2020. So in the regulations themselves, they contemplate a methodology for changing the salary, upgrading or updating, if you will, the salary component to the white-collar exemption every 3 years. Now, a third change that was made in the regulations addresses what is known as the highly compensated employee. Under the current rules, any individual who is paid an annual salary of $100,000 or more, and they meet any one of the elements for a white-collar exemption, then they are exempt as a highly compensated employee. These new regulations raise that exemption dollar amount to $134 or $134,004 annually. And again, for purposes of the highly compensated employee, they only have to meet one aspect of the definition of exempt. For example, an executive, which traditionally would be a supervisor, is someone who is in charge of a unit or subdivision of a business and typically supervises 2 or more people. Well, if a highly compensated executive meets either of those 2 components, they would qualify as a highly compensated employee. Now, another component of the changes in the Department of Labor regulations is the use of a non-discretionary bonus or commission payment to meet the salaried requirement under the regulations. This can be up to 10% of the individual's guaranteed salary. In other words, if you pay an executive 90% of the guaranteed salary of $913 a week, which comes out to $821.70 a week, or $42,728.40 a year, and if they receive the additional 10% to bring their salary up to $913, and they get that bonus or compensation at least quarterly, then they will meet the executive exemption. What it amounts to is basically a guaranteed bonus or commission that will make up any shortfall between the payment of $821.70 per week and the $913 required to meet the exemption. And for a regular exempt employee, that has to be paid at least quarterly. Now, for highly compensated employees, those individuals that are paid $134,000 a year, the bonus concept works a little differently. Because the salary for a highly compensated employee is an annual salary of $134,000, then they must receive the guaranteed salary each week of $913. And then at the end of the year, you would have the option to make up the difference to get them up to the $134,000 by paying them the difference between what they have already earned during the year and the amount that will get them to the $913 or the $134,000 for the year. Again, that only has to be done once, but the bonus for an exempt person at $913 has to be paid at least quarterly. So at the year end, for highly compensated employees, you would have to make up the difference through a non-discretionary bonus or commission plan. Now, you have probably read that there are plenty of different ways and different action plans that employers have considered to try and address their compliance with these new regulations. One of the things that we strongly recommend is that everyone go back and review those individuals that they currently have classified as exempt so that they can ensure that they truly do meet the duties requirements under the Fair Labor Standards Act. Since those duty requirements are not changing, it's best to go back and look and make sure that you are in compliance now. Some of the ways that people may try to address these regulations is to raise the salary of those who are currently classified as exempt so that they will meet the exemption. In other words, bring their salary up from wherever it is now to the $913 amount per week. There are others who will not be able to make that decision, who will end up converting individuals from exempt to non-exempt, in which case they would be eligible to receive time and a half for overtime for hours worked over 40 in a work week. This might be by converting them to an hourly rate of pay or converting them to salaried non-exempt with a specified rate of pay for which they would be eligible for overtime premiums. Some organizations may reorganize their workloads in an attempt to try and reduce the amount of overtime hours that are actually being worked. Another option that you are seeing people think about is hiring more people in an attempt to avoid overtime. So they may reorganize their workload to provide more work for individuals who truly meet the exemption, to reduce the hourly work on those who are questionable, or they may hire more people in an attempt to avoid overtime altogether. Now, the last thing I want to discuss is the fact that there have been any number of recent activities that may fill someone with some thought that, well, maybe this is not going to happen. There was a House bill filed in March of 2016 to block the implementation of this final rule and an attempt to force the Department of Labor back to the drawing board to reconsider the rule. It was an attempt to eliminate the automatic update. The bill currently has 198 sponsors, the last one which was added back in September, on September 20th. It was referred to the House Education and Workforce Committee. It's called the Protecting Workplace Advancement and Opportunity Act, and a Senate bill has been filed as well. But it has been referred to committee and no further action has been taken. There was a second bill passed, the Overtime Reform and Enhancement Act, which was filed on July 14, 2016, to provide for a 3-year phase-in of this upgrade to the salary compensation level. And it was also proposed to eliminate the automatic upgrades in the Department of Labor regulations. Here again, that has been sitting in committee and it has not moved since that time. A third bill was filed just 2 weeks ago on September 21st, and that bill was to delay the implementation of these regulations by 6 months. It has the same sponsors as the prior bill 5813 that was filed on July 14th. It's called the Regulatory Relief for Small Businesses, Schools, and Nonprofits Act. It actually passed the House on September 28th, and the Senate proposed its own bill. But before you get too excited about that, you need to recognize that President Obama has indicated he would veto any bill of that nature that came before him, and the margin that the bill was passed by the House would not be sufficient to override any veto of the President. Finally, this is the last action that we have seen recently, is our lawsuits that were filed on Tuesday, September 20th by the United States Chamber of Commerce in the Eastern District of Texas claiming that the Department of Labor has exceeded its authority under the Administrative Procedures Act in passing these regulations. There are 50 various local chamber and national organizations that joined in that lawsuit. There were 21 states which also joined that lawsuit, including the state of South Carolina. And primarily, the lawsuit seeks an injunction to prevent the implementation of this rule. Again, I wouldn't necessarily bank my last or bet my last paycheck on that that lawsuit being successful, but it'll be interesting to see whether or not a district judge will stay the legislation or the regulations. So that is an up-to-date review of the changes to the Fair Labor Standards Act regulations. If you are interested in hearing more that came out of the debate of the panel members from the original presentation on the 22nd, please click on the other link on the Chamber's website, and you'll be able to hear some of that discussion with Leslie Hayes and Julie Brown. Thank you.